The gross domestic product is an economic indicator, which indicates the total value of goods and services produced in a country, and analyzes the health and economic growth of a particular country. In 1934, the modern version of the GDP was introduced by Simon Kuznets, who won the Nobel Prize in Economics. In 1944, at the Bretton Woods Conference, the GDP became the main method of measuring the economy of a particular country. The GDP reports have a strong influence on the market sentiment, and often shake the market with high volatility. This volatility can last for hours, especially when results deviate significantly from the analyst's forecasts. The speed of volatility created after the release of the GDP can create many high-risk and high-reward trading opportunities. GDP is considered an important part of fundamental analysis, and in the economic calendars it is marked as a high-impact event. Professional traders carefully analyze the GDP release to decide whether to open a new position or whether to support the active ones. The GDP is based on 4 key elements: the consumption of private and public goods, private and public investments, government expenses, and foreign trade. The general formula to calculate the gross domestic product is equivalent to the total consumption of personal goods, plus the total investments, plus the total government expenditures, plus the total exports, minus the total imports. The GDP figure may not always be reflected by the market. Often GDP data is already partially integrated into the market, meaning the market may not react as expected once the data is released. GDP is a lagging indicator, which means that it is only calculated at the end of the concentration period. Therefore, it does not take into account real-time economic change. However, this all depends on the expectations of the analysts. If the figure turns out to be worse than expected, it means that the economy is shrinking, and a recession could begin. The currency of the economy will have a bearish movement. If the figure is better than expected, it means that the economy is expanding and investors are gaining confidence. The currency of the economy will have a bullish movement. If the data is the same or differs slightly from the expectation, bilateral movements may occur, without excessive volatility. If the periodic change in GDP is negative, for 2 consecutive periods, the alarm bell could start to sound, as it would be considered a signal of economic recession. GDP is calculated periodically, on a quarterly or annual basis, to measure how the economic value of local production activities change over time. GDP for the dollar, pound, and Canadian dollar has a monthly, quarterly, and annual release date. GDP for the euro, the yen, the Australian dollar, and the New Zealand dollar has a quarterly and annual release date.